Hello and welcome to Monday Skills Banking and Financial Services Career Series. My name is Ajit Nair. I'm a career coach specializing in banking and capital markets technology and business operations careers. I've spent 20 plus years in this industry, developing technology and operations solutions for some of the largest banking and financial services firms across US, Canada, and Europe. This video is designed to guide freshers and early career professionals on some of the exciting career opportunities available in the field of banking and capital markets operations. By watching this video till the end, you will have a clear understanding of various roles that could help you launch your career with leading investment banks and financial services firms. We'll discuss day-to-day job responsibilities, activities involved, the career path ahead, and the essential skills you will need to succeed in these career roles. We will also share insights into top companies that are hiring for these roles and tips on how to stand out in the job application process. If you have any questions or need further assistance after watching this video, please feel free to email us at careersupport@mondayskills.com. We will start by looking into the career role as a KYC analyst. KYC regulations originated in 1970 when US passed the Banking Secrecy Act to prevent money laundering. This act required banks to conduct due diligence on their clients at the time of opening of the account. After the 9/11 attack on the Twin Towers in New York, US Patriot Act was passed in 2001, which expanded the KYC requirements for financial institutions. In the last 2 decades, financial institutions across the world have hired thousands of KYC AML professionals to comply with the regulatory requirements. If you go and search for KYC jobs on popular job boards, you'll find thousands of job openings. Most of these job openings will be for KYC associates or KYC analyst roles, where freshers and early career professionals can launch their career. In this section, we are going to look at the KYC associate or a KYC analyst career role. You would have probably completed the KYC documentation when you opened a bank account. KYC or Know Your Customer is closely linked to financial crime prevention. KYC is the process that a financial institution uses to verify the identity of customers and assess the potential risk associated with their transactions. In accordance with the anti-money laundering requirements, banks across the world are obliged to perform Know Your Client or KYC reviews on all new clients they sign up. These checks and reviews are made in strict accordance with the regulatory requirements within a country and banks' internal policies. Financial crime refers to crimes committed by an individual or a group of individuals to provide economic benefits through illegal methods. Some of the common financial crime methods include money laundering, identity theft, credit card fraud, corruption, bribery, securities fraud, etc. According to leading IT and business operations research firm Celent, banks spend more than 30 billion in KYC operations and technology. You may be wondering, why do banks spend so much money on KYC AML? Well, that's because regulators across the world have been imposing large fines on banks who are non-compliant with the KYC AML requirements. Since 2008, banks have paid more than $50 billion in fine for not complying with the regulatory requirements. Regulators have imposed fines of more than $2 billion each on some of the leading banks that include BNP Paribas, JP Morgan, UBS, Goldman Sachs, HSBC, Standard Chartered, etc. In the US alone, banks have paid more than $30 billion in fine. A KYC or Know Your Customer analyst is a professional responsible for verifying the identity of a customer and assessing potential risk associated with them for the financial institutions and businesses. Their primary role is to ensure compliance with anti-money laundering and counter-terror financing regulations. KYC analysts are the first line of defense for banks to keep bad actors out of their system. Let us now look at who hires KYC analysts. KYC analysts are hired by various types of financial institutions and organizations subject to regulatory requirements to conduct customer due diligence and prevent financial crimes. Some of the entities that hire KYC analysts include commercial banks, investment banks, and other banking institutions who need to ensure compliance with the anti-money laundering and know your customer regulations. Asset management firms, wealth management firms, and other financial service providers hire KYC analysts to onboard clients and manage risk associated with the customer accounts. Insurance companies hire KYC analysts to verify the identity of the policyholders and assess potential risk. Brokerage firms and securities dealers hire KYC analysts to conduct customer due diligence for securities trading. Fintech startups, cryptocurrency firms, and money transfer service providers hire KYC analysts to comply with the regulatory requirements and ensure security of their platforms. Large organizations may have a dedicated compliance and risk management department, and they hire KYC analysts to oversee customer due diligence and ensure adherence to the regulations. Government agencies involved in financial oversight and regulations may also hire KYC analysts to monitor compliance in the financial services sector. Some consulting firms provide KYC services to other organizations and hire KYC analysts with expertise in customer due diligence and AML procedures. KYC jobs have a low entry barrier. Most firms hiring KYC analysts look for candidates with an undergrad degree. An ACAM certification in KYC will help associates get faster career growth and a better pay. Skill Board certification in financial crime compliance or a certificate course from Financial Crime Academy can also help you accelerate your career in the KYC AML compliance space. Key responsibilities of a KYC analyst include examining identity documents, financial statements, and other relevant records to verify customer identities and compliance with the regulatory requirements. KYC analysts assess the risk of customers based on various factors like country of origin, business type, transaction patterns, and reputations, etc. They conduct research on customers, related parties, beneficial owners to ensure transparency and legitimacy of the business relationships. KYC analysts need to collaborate with internal users, compliance officers, and sometimes with clients to gather necessary information and clarify on any discrepancies in the documents provided by them. They maintain accurate and comprehensive records of customer due diligence and interaction for auditing and reporting purposes. Continuous monitoring of customer accounts and transactions to detect suspicious activities and report any potential red flag to the compliance team is another responsibility of the KYC analyst. KYC Associate is the entry-level position for most KYC professionals, though some banks may hire KYC analysts at entry level as well. KYC analysts with 3 to 5 years of experience can become team leads, in addition to managing day-to-day KYC operations. With further expertise, they can become KYC manager, where they would manage the KYC operations for a geo or a category of clients. KYC AML career roles are popular with career starters, as it offers multiple alternate career paths for professionals once they have some experience in the KYC domain. Some KYC analysts move into IT group as business analysts, while some other KYC professionals with ACAM certification can become AML compliance officers with banks. With 7 to 10 years of experience in KYC and compliance, some analysts move into broader risk management or compliance management roles within the organization. Experienced KYC analysts may also have opportunities to work as consultants or advisors, providing KYC and AML expertise to other organizations. If you want to grow in KYC AML career, then you should consider pursuing AML and KYC certification from ACAMS. Top employers of KYC analysts include Citibank, JP Morgan, Bank of America, Wells Fargo, Lloyds, Barclays, Deutsche, etc. Service providers such as Accenture, Genpact, TCS, Wipro, HCL, etc. also hire KYC analysts. Given the low entry barrier and a large number of openings, KYC associate roles are popular among career starters. With accredited industry certification, this domain offers excellent growth opportunities for KYC analysts. If you're interested in a career as a KYC associate and need help in preparing for industry certification, then you can write to us at careersupport@mondayskills.com. The front office or the sales and trading function in an investment bank is a critical component of the financial markets. The trading team executes trades on behalf of the institutional clients, such as asset managers, pension funds, hedge funds, etc. They also execute trades for the bank itself in a principal capacity. The front office trades in a wide range of financial instruments, including equities, bonds, money market products, currencies, and derivatives. While the front office focuses on revenue generating activities through trade execution, the operations team play a crucial role in the post-trade activities across trade lifecycle, leading to trade settlement. Securities Operations Associates work for different securities firms. These associates, when they work for investment banks, are known as Investment Banking Operations Associates. The back office operations team in an investment bank or a financial institution is responsible for various administrative and support functions that ensure smooth running of firm's operations. As we go into the details of these roles, keep in mind that Securities Operations Associates and Investment Banking Associate roles are similar in nature and have been used interchangeably within this video. Let us look at who hires Investment Banking Operations Associates or Securities Operations Associates. As discussed earlier, investment banks, asset management firms, and custodians hire associates for supporting their day-to-day operations. These include client onboarding, static data setup, and post-trade processes. Some asset management firms outsource their middle office operations to custodians and other service providers who hire Securities Operations Associates for trade processing. Custodians also hire Securities Operations Associates for custody and settlement operations. The key responsibilities of Securities Operations team or Investment Banking Operations team include onboarding of new institutional clients and setting up static data for these clients, working with various internal teams such as middle office, pre-matching, settlement team, cash processing team, and asset servicing team to process transactions and resolve exceptions, if any, in a timely manner. They're also responsible for end-to-end processing of securities settlement across the trade lifecycle and managing multiple markets globally. Investment banking associates are responsible for reconciliation between front office and back office. They perform nostro and depot reconciliation to ensure cash and securities positions of different investment funds are properly accounted. Investment banking associates investigate and resolve any trade-related breaks in accordance with the established work practices and procedures to ensure timely settlement of securities trade. Now, key skills required for investment banking operations or securities operations associates to perform their day-to-day activities include knowledge of investment instruments and market participants. They need to have a good understanding of the trade life cycle and need to have strong communication skills as they need to effectively liaison with counterparties and internal stakeholders. In terms of career path, securities operations associate with 3 to 5 years of experience can become a team lead in the process area they are working in. If you want to launch your career and grow fast, then Securities Operations Associate is an excellent stepping stone in financial services industry. However, most associates fail to upskill themselves and end up in the operations job for too long to grow. Associates with 2 to 3 years of experience and good understanding of institutional trade lifecycle can venture into IT as business analysts that opens up opportunities across the world. So if you are someone who is aspiring to grow big, then Securities Operations Associate career could be a good launching pad. If you're interested in a career as a Securities Operations Associate and you want to stand out from the crowd when applying for a job, then it's important for you to show your knowledge of financial markets, market participants, financial instruments, trade life cycle, and market conventions. We strongly recommend you to take a certification course in securities and capital market. Some of the recommended courses include Bloomberg Market Concept Certification from Bloomberg or Certified Business Operations Associate in Investment Banking Operations from Skillboard. Top employers of Investment Banking Associates or Securities Operations Associates include Citibank, JP Morgan, Bank of America, Wells Fargo, Barclays, Lloyds, State Street, Bank of New York Mellon, Invesco, Northern Trust, Brown Brothers, Harriman, etc. Some of the service providers such as Accenture, Genpact, TCS, Wipro, HCL, Infosys, etc. hire large number of investment banking operations associates or securities operations associate. We hope you found useful insights into investment banking associate or securities operations associate career role. Investment banks and other securities firms employ large number of career starters as operations associates. If you're interested in a career as an investment banking associate and need help to launch your career, then you can write to us at careersupport@mondayskills.com. In the capital market business, there are thousands of institutional players such as investment banks, broker-dealers, custodians, hedge funds, mutual funds, etc., who trade in millions of securities. These securities or financial instruments have hundreds of attributes such as security identifier, issuer identifier, industry classification, coupon rates, ratings, etc. The static data about the securities and entities in the trading are key to investment research, trade execution, post-trade processing, risk management, etc., and is known as reference data. Reference data associates in the financial services industry are professionals who are focused on managing and maintaining reference data related to various financial instruments, entities, clients, and counterparties that a securities firm may be interested in. Let us look at what kind of firms hire reference data associates and what they do for them. There are three different types of firms who hire reference data associates. First, reference data vendors such as Bloomberg, Refinitiv, S&P Global, Intercontinental Exchange or ICE, etc., who acquire reference data from various sources and then distribute to securities firms such as investment banks, asset managers, etc. Reference data associates working for data vendors research variety of legal and financial documents, third-party reports, and vendor-provided information to extract reference data from these sources. This reference data is then cleansed and supplied to other securities firms, such as investment banks, asset managers, mutual funds, hedge funds, etc. Second type of firms that hire reference data associates are securities trading firms. These include investment banks like Goldman Sachs and Morgan Stanley, asset management firms like BlackRock and Invesco, custodians like State Street and Bank of New York Mellon, etc. These firms are some of the biggest employers of reference data associates. Reference data associates are responsible for regular maintenance of securities that require coupon or interest rate updates or factor updates, which they do by researching on a daily basis from sources such as Bloomberg or Reuters, etc. They perform research through Bloomberg and Reuters terminal and acquire additional or missing information that may be required to complete the setup or maintenance of these securities. These activities that reference data associates perform early in their career help them grow as reference data and market data specialists in their career. Third type of firms that hire reference data associates include business process outsourcing firms such as Accenture, Genpact, TCS, Wipro, HCL, etc., who provide services to data vendors and securities firms. They hire reference data associates and deploy them on their BPO projects with investment banking and other securities clients. Let us now look at who can become reference data associate. Most firms hiring reference data associates look for candidates with an undergrad degree in finance, accounting, or science. An MBA in finance or certification in financial markets is highly desirable. Skills needed to be successful in this role include knowledge of key attributes of various financial instruments, such as equities, bonds, and derivatives, and knowledge of entities such as companies, issuer, counterparties, etc. Knowledge of financial markets, including trading and post-trade processes, corporate actions, market conventions, etc., is important for reference data associates to perform their day-to-day job effectively. Familiarity with data management systems and technology is essential for this role. Reference data associates may work with specialized software such as Bloomberg Terminal or a Reuters Terminal or some custom softwares. Since these are specialized softwares, financial services firms provide comprehensive training to associates when they join the firm. Given the importance of accuracy in reference data, being detail-oriented is essential to avoid errors and inconsistencies. Therefore, reference data associates need to be detail-oriented. Reference data associates often encounter data-related challenges that require investigative and problem-solving skills to resolve any discrepancies and ensure data integrity. Therefore, reference data associates need to have very strong problem-solving skills. Strong communication skills are necessary for collaborating with team members, stakeholders, and data vendors to obtain and provide accurate reference data. Therefore, reference data associates need to have very strong communication skills. Reference data associate is the entry-level position where individuals start their career in reference data management. They focus on data entry to set up security, validate the securities, and do maintenance tasks on these securities. During this time, they learn about the financial instruments, entities, and market conventions. They also learn to handle specialist vendor platforms such as a Bloomberg terminal or a Reuters terminal. Early career reference data associates in the US earn anywhere between $40,000 to $50,000, whereas the compensation for early career reference data associates range between 3 to 7 lakhs in India, with a median salary of around 5.5 lakh rupees. After gaining some experience as a reference data associate, they may be promoted to the role of reference data analyst. At this stage, they take on more complex data analysis and problem-solving tasks and may be involved in process improvement initiatives as well. Next, as senior reference data analyst, they demonstrate high level of expertise in reference data management. They might handle specialized or more challenging reference data categories, mentor junior associates, and take lead role in data governance and data quality control efforts. They may also lead a small team as senior reference data associate. Reference data analysts with 3 to 5 years of experience may move into IT organization as business analyst or data analyst. If they continue with the operations team, then these reference data analysts will become a lead in 5 years and then a reference data manager in 7 to 10 years, where they will be handling broader responsibilities as reference data managers. If you're interested in a career as a reference data analyst and want to stand out from crowd as you're applying for the jobs, then you need to showcase your knowledge of financial markets, market participants, financial instruments, trade life cycle, and market conventions. You can take up a certification course in securities and capital markets. Some of the recommended courses include Bloomberg Market Concepts from Bloomberg and Certified Business Operations Associates in Securities Data Management from Skillboard. You can apply for jobs with data vendors such as Bloomberg, Refinitiv, Intercontinental Exchange, etc. Investment banks, JP Morgan, Goldman Sachs, Citibank, Deutsche, Barclays. Asset management firms such as Invesco, BlackRock, Fidelity, Vanguard. Custodians such as State Street, Bank of New York Mellon, Northern Trust, Brown Brothers, Harriman, HSBC. IT services firms such as Accenture, TCS, Wipro, etc. Reference data domain can be an excellent stepping stone for freshers and early career professionals, as companies mentioned earlier regularly hire reference data associates. We hope you found this overview of reference data associate career role informative. If you want to pursue career as a reference data associate and need help, then you can write to us at careersupport@mondayskills.com. Some of you may be aware that in 2008, world witnessed the biggest financial crisis when Lehman Brothers filed for bankruptcy. This event highlighted the importance of credit risk in securities trading and capital market operations. With regulators tightening the rules around OTC derivatives trading in the last decade, collateral management has emerged as one of the most important tools in managing credit risk. In this segment, we'll talk about some of the exciting career opportunities in collateral management operations for freshers and early career professionals. Let us take a look at them. In the stock market, when people trade in securities like stocks and bonds, there is a risk that one of the two parties in the trade might not be able to fulfill their obligation. For example, the person who bought stocks might not be able to pay for the stocks they bought, or the person who sold stocks may not be able to deliver the stocks they sold. This risk that one of the parties in the transaction will not be able to fulfill its obligation to the other party is known as counterparty risk. To make sure trades go smoothly, banks and other financial institutions use smart ways to manage these risks. They check the creditworthiness of the trading partners or the counterparties, set limits on how much they can trade, and ask for something valuable as a backup to cover for the losses in case they default. This backup is known as collateral. Think of it as a safety net for traders to avoid any problems in the future. This is similar to a bank keeping the car as a collateral when they give a car loan, or keeping the home as a collateral when they give a home loan. Collateral management is the process of deciding how much backup is needed to cover for losses if something goes wrong. In the securities industries, shares, bonds, and cash are usually accepted as collateral. Collateral management helps to reduce risk of trades going bad. It also helps to make sure that trade settlement happen on time and collateral resources are used more efficiently. A collateral management associate is a professional who works in the financial services industry, specifically in the area of collateral management. Let us look at the responsibilities of a collateral management associate. If you become a collateral management associate with one of the financial services firms, then as a collateral management associate, you will be responsible for managing the collaterals your company holds from its counterparties. Your responsibilities include setting up and maintaining collateral data on the collateral management system, uploading trades into the system, and monitoring various feeds which come into this collateral management system from different source systems. In the securities trading business, margin calls are issued to counterparties when the collateral requirement changes due to the market fluctuations. As a collateral management associate, you will be responsible for issuing these margin calls and chasing counterparties to ensure they meet their obligations. Sometimes counterparties also issue margin calls to your bank. So as a collateral management associate, it's your responsibility to verify if the margin calls are valid, and if yes, then provide additional collaterals to the counterparties. In some cases, counterparties may dispute the margin calls. In those situations, you will work with the counterparties to resolve those disputes. Other responsibilities of collateral management associates would include reconciling book of accounts, chasing clients on failed or missed payments, booking interest on monthly clients, investigating any interest rate discrepancies or any of the financial transaction discrepancies, and working on collateral substitutions as requested by the customers. To become a collateral management associate, you usually need a bachelor's degree in finance or accounting. If you have an MBA in finance or a certification in financial markets or derivatives, then your path can be much easier. The skills needed to be successful in this role include knowledge of derivative products, understanding of trade life cycle, ability to interpret ISDA and GMRA documentation or contracts, strong communication skills as you need to communicate with counterparties and internal associates, and experience in portfolio reconciliations and collateral management operations. Talking about the career path, the starting position for most individuals in the collateral management domain is as collateral management associate, where they will be primarily focused on setting up the static data from collateral agreements, issuing margin calls to the counterparties, and following up with counterparties if there is a delay in responding to collateral calls. Early career collateral management associates in the US make around $50,000 to $60,000, whereas median salary for early career collateral management associates is around 6 lakhs in India. After gaining some experience as collateral management associate, individuals may be promoted to a collateral management analyst role. In this position, they handle more complex collateral management tasks, including dispute resolution on margin calls. They may also have a supervisory responsibility for collateral management associates. With 3 to 5 years of experience in collateral management, analyst earns around $75,000 in US and 8 to 10 lakh rupees in India. As they grow further with 7 to 10 years of experience and a demonstrated leadership skills, collateral management analyst can advance into the role of a collateral manager. Compensation at these levels are significantly higher compared to most operations job in financial services, with a median salary of around $110,000 in the US and around 15 lakh rupees in India. To stand out from the crowd while applying for a job in collateral management domain, you need to showcase your knowledge of collateral management and securities trade life cycle. You can get certified as Business Operations Associate in Securities Lending and Collateral Management from Skill Board to establish your credibility as a collateral management professional. Let us look at what companies hire collateral management associates. Well, it turns out that collateral management associates are hired by almost all large financial institutions who trade in securities. These include commercial banks, investment banks, asset management firms, hedge funds, custodians, and other security service providers. Top employers include JP Morgan, Deutsche Bank, Goldman Sachs, Barclays, Societe Generale, State Street, Citibank, Bank of New York Mellon, Fidelity, etc. These firms deal with significant amount of financial transactions and require skilled professionals to manage and optimize their collateral assets. IT and business process outsourcing firms such as Accenture, Genpact, Citco, TCS, Wipro, HCL, etc. provide services to securities firms. They hire collateral management associates and business analysts and deploy them on the projects with their investment banking and securities clients. We hope you found this overview of career as a collateral management associate informative. If you want to pursue career as a collateral management associate and need help, then you can write to us at careersupport@mondayskills.com. Let us now look into the career as a mutual fund accountant. A mutual fund is a type of investment vehicle that pools money from many investors to invest in stocks, bonds, and other securities. It is managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds are popular investment choice for individual investors who want to participate in the financial markets but do not have the time or expertise to manage their own portfolio. They offer a simple and affordable way to invest in a wide range of assets and achieve long-term financial goals. Investors investing in mutual funds generally buy shares or units of the mutual fund based on the net asset value, commonly known as NAV of the mutual fund. Mutual funds are regulated by the financial regulatory authorities in most countries. These regulations are designed to protect the investors and ensure that mutual funds operate in a fair and transparent manner. Fund accountants are accounting professionals who are responsible for maintaining book of accounts of a fund and calculate the NAV of the fund on a regular basis. Most mutual funds calculate and publish their NAV on a daily basis. Similar to mutual funds, hedge funds are also collective investment plans that pool in money from high net worth investors or accredited investors. However, unlike a mutual fund, hedge funds are not tightly regulated. Accountants who manage the accounting for hedge funds are also known as fund accountants. Fund accountants are typically hired by mutual fund companies and asset management companies like Fidelity, Vanguard, BlackRock, etc., and hedge fund companies such as Citadel and Bridgewater. Fund accounting service providers like State Street, Bank of New York Mellon, Northern Trust, Citco, SS&C, etc., who provide fund accounting services to asset management firms and hedge funds, are also large employers of fund accountants. The primary role of a fund accountant is to ensure accurate and timely recording of financial transactions related to the fund. The key activities include calculating the NAV of the investment portfolio, anticipating and recording all income such as dividend, interest, etc., recording all the accrued interest on bonds for the bond valuation, amortizing the discount or premium on the bonds, or recording any securities transactions such as buys and sells within the investment portfolios. They are also responsible for calculating the capital gains, both short-term and long-term, as a result of the securities transaction in the fund. They also record all the inflows and outflows into the fund due to purchases and redemption of the mutual fund shares or units by the investors. Fund accountants also prepare various financial reports, including quarterly report, annual report, etc., that provide investors and regulators with comprehensive view of funds' performance and financial health. Fund accountants working for hedge funds are also responsible for calculating the performance fee, which is an important factor when it comes to the payments made to the hedge fund managers. Most companies employing fund accountants look for candidates with an undergrad degree in accounting or finance. An MBA in finance or an undergrad certification in financial accounting can be considered for fund accounting jobs. While most accounting activities these days are performed programmatically, still, the fund accountant needs to be well versed with different aspects of fund accounting. These include fund structures, investment instruments, trade life cycle, securities valuation process, journal entries, tax lot accounting methodologies, trade and transaction booking, cancel and rebook process, etc., to support the daily NAV production. Career starters in fund accounting are typically trained by the financial institutions on the fund accounting softwares. The starting position for most individuals in fund accounting is as fund accountant. After gaining some experience as a fund accountant, individuals may be promoted to the senior fund accountant role. In this role, they take up more complex accounting tasks and may have a supervisory responsibility for junior fund accountants. With 7 to 10 years of experience and demonstrated leadership skill, fund accountant can become a fund accounting manager. If you're interested in a career as a fund accountant and want to stand out from the crowd when applying for a job, then you need to showcase your understanding of financial markets, market participants, financial instruments, trade life cycle, and market conventions. Top employers of fund accountants include State Street, Bank of New York Mellon, Citi, JP Morgan, Brown Brothers, Northern Trust, Invesco, Society General, HSBC, Deutsche Bank, Morgan Stanley, etc. Some of the large IT and business process outsourcing service providers such as TCS, Citco, Wipro, HCL, and Apex Systems provide services to hedge funds and mutual fund companies. They also hire fund accountants for providing accounting services to these firms. This was a quick overview of career as a fund accountant. If you want to pursue career as a fund accountant and need help in building skills, then you can write to us at careersupport@mondayskills.com.